So I went without a PowerPoint today because I guess I'm kind of a believer that negotiation doesn't really lend itself to PowerPoint. So I hope that's okay with you guys. I do have copies of the slides if you want them, but I prefer to go without that. So she did give my background, and I might just add to it a little bit. I became interested in the technology space when I was with the Securities and Exchange Commission because I worked on some of the early cell companies, and just, got an interest from doing that. And then when I went into private practice in Pittsburgh, after I finished my master's degree, I worked with Buchanan Ingersoll, and at that time they had a leading technology practice, and then just kind of continued it over the last 25 years or so. So part of what I wanted to talk about today is just negotiation from the standpoint of what I would call the underdog, the startup company, and how that's different from negotiating from the other side. And I've had the benefit of doing both, so I'm going to try to give you the perspective of both of those things, so that both of those parties, so that you can get some feel for how it's different, and the type of things that you may want to do is you enter into early stage negotiations over different things. And I'm going to give some examples of the kind of negotiations you may have, and what you may hope to get out of those different kinds of negotiations. So what I wanted to start with and sort of wind this through the presentation was a company that I represented about 15 or 20 years ago, and the entrepreneur involved was he was a serial entrepreneur, so he had done it several times before that, and he was building out a company in the pharmacy software space. And so his strategy on building out companies was usually start with a small one and a core technology, try to solve a much bigger problem for a much bigger audience, but take that core, and then through acquisitions of technology and through acquisitions of customers, put that into the sweet spot of an industry that was looking for a solution. So that industry at the time in pharmacy software, the way it was being done was that individual stores had software systems. So they were all kind of one-off. There were many, many vendors in the space. And so an independent pharmacy might have 6 stores. And so what they would do is buy 6 software licenses, install them into the stores, and there was no cross-fertilization between those stores, other than at the end of the day they might aggregate their numbers and then send them into a central place and then put them all together. So that's the way it was being done. And he looked at that industry and actually first understood that there was a shortage of pharmacists in the industry, so that if they could come up with a solution that would allow them to automate more things, they would be able to leverage the pharmacists more. But later came to a different understanding about that industry as he was building out the company. So that's just kind of something I'm going to wind through some of the negotiations we did for him, just as examples of the kind of negotiations that you'll do. So when I look at negotiation, I don't really use a highly theoretical model in doing it. I sort of look at 3 things for the startup, okay, focusing on the startup. And the first is determine what you need today. And the reason I say that is a lot of times people go into negotiations and they think they have to solve all their problems with the one negotiation, whether it's the first license that they enter into, the first customer, or the first person they hire. But what you really need to do is look at the problem that you have in front of you today and say, what do I really need to solve? And I'll go through some examples so you can see what I mean. And the second thing is to take a step back, and hopefully you've had some conversations with the party that you're negotiating with, so that you understand them a little better. And that's to try to understand, what do they need? And again, taking this from the standpoint of you're the small company and they're the big company, you may find that what you think they need is not actually what they need. And I'm not just talking about the pure technology solution, I'm talking about the personalities involved and what they hope to get out of the negotiation. And the third thing is, as a small company, build in as much margin of error as you can. because what may happen is that you're sort of investing everything in this first kind of relationship that you have. And for them, it may be one of 5 or 6 strategic partnerings that they have with smaller companies or mid-sized companies. So it doesn't have the same importance for them as it does to you, meaning that if it doesn't work out in a way that you want it to, you want to build in some cushion into that so that you can maybe exit the relationship or whatever you need to do. So the first thing that I was going to look at, or just evaluate at kind of a high level, is just the university license itself. And so I know some of you have negotiated university licenses. Would you show me if you have, or you've been involved with negotiation? I know Stuart has. Yeah, so get back to you. Okay, so you haven't gone through the process, most of you. So I'm just going to, again, talk about this in really high-level terms so you can understand it. The basis of the university license is, for most people, it's the core technology that you're trying to license out of the university. So from your standpoint, what you need in most instances is the technology itself. So you need a license to the technology. But you want a little bit more than that, because your business model may not involve you selling directly to clients all the time. It may involve you selling through other people to clients. So you not only want a license, but you want sub-license rights. And as a part of that, you need to evaluate the economics of both what do I pay when I have a license, what do I pay when I sub-license it to other people. So at a very high level, again, what you're trying to get is the core technology, and you're trying to figure out how will this work through my revenue model for this particular company. Now, what is a university interested in? Well, for one thing, it wants to commercialize the technology, so there's not really an issue about that. It could prefer to, commercialize it through a bigger party, but in many, many instances, it's going to license it out to the inventors of the technology because they're the ones who are probably in the best position to commercialize it, and they want equity, that they'll typically take some equity in your company around very prescribed percentages, and they want royalties, meaning that as you license the product, they get some subset of what you've licensed. But probably the most important part about negotiating a university license at a very high level is that there are many things in the license that they're not going to negotiate. And it's kind of important to understand that ahead of time. And it's also important to understand why won't they negotiate these points. And the reason is this. So they're going to, let's say, license it out to you. You're a small startup, promising, and you have great ideas for what you want to do with the technology. From their standpoint, they're not willing to put the whole university at risk by licensing it out to you. So there'll be many provisions in the license agreement, such as limitations on liabilities, indemnities, how you pursue if somebody infringes your technology or you infringe theirs, where the university sort of steps back from that and says, if things don't work out here, I don't want to be on the hook for millions of dollars of losses. So when I license this technology to you, in some respects, it's kind of as is where is, right? And when you go to most parties that you want to deal with in the future, and if they want to see your university license and they see that, they're going to understand that. So if they've dealt with universities before, they're going to say, that's not a problem. We know that's what the parties put in the license. But the key takeaway point is, again, their interest is a little different than yours. There's a lot of things that you're not going to be able to negotiate with them. And those things in large part don't matter. So it's not worth spending a lot of time trying to get them to change their mind about something that they're not going to do. So in terms of the third type of thing that you're doing, you're trying to build in a cushion, as I mentioned before. So what's the cushion you want to build into a university license? Well, there's a couple of things. One is that there'll be a schedule of developments that they want you to make as you sort of progress towards commercialization of the technology. What you'd like to do is have some flexibility in that schedule, because in many, many instances, you won't hit the deadlines that they have, and they won't care. So they're really interested in whether you're in earnest, whether you're really trying to make a go of this, but they're not going to pull the plug on you because you're 3 months late on meeting a certain milestone that you put in the agreement. So those kind of milestones, if you say, I think I could hit this in 6 months, try to put a year into your license so that you've always got more cushion in there than what you think. And the other is, you may want but not be able to get things like options on future technologies. And if you can't get them because they're unwilling to give them to you, if you're just monitoring what's happening with those technologies, or more likely even being involved with the development of those, you just go back to them at a later point in time and say, I'd like to license this too. Most of the time, they'll just push it under the same license that you have with them. Sometimes they'll want a separate license. So I wanted to go back to this TechRx example as you look at building out the company and your first key hire that you have within the company itself. So in the TechRx example, that was that pharmacy software company, they had decided that what they were going to do was come up with a industry-leading solution, but still sell it in kind of the same way they had before, which is they were eventually going to reach the point where they determined that it should go cross-platform and that they were going to try to sell it to much bigger companies. But at this point in time, they just determined what we're going to try to do is sell it through the existing channels that sell pharmacy software. So what we need for our first key hire is a sales guy, sales manager, who actually knows how to sell through channels. And at that time, it may even be true today, there were really only a couple of key channels for pharmacy software, and it was basically Cardinal Healthcare, McKesson, and Bergen-Brunswick. Those were the three big wholesalers in that space. So what they determined to do is, we're going to hire a real superstar out of one of these companies who are going to come in, and that's going to be the person that pushes our sales through those channels, because that's all we really need. So that's what they did. They went out, they found a person who really met the bill. And what was interesting about the negotiation, although I was not part of that one, was that that person who had been with a really big company, his main interest in coming into the small company was, I want to get equity, right? Because I make a lot of money selling the stuff that I sell today, but what I really like is equity in this company, which I totally believe in. And that's my interest. That's how I'm going to leave my multi-$100,000 a year company, salary that I get today, and instead be willing to take less money but get some significant equity stake. So what he negotiated for was that he would always own a certain percentage of the company. So he basically got 3 or 4% going in, but he negotiated a provision with the CEO that said, regardless of how much money you raise, regardless of whatever you do, I always own 2% of the company. So the CEO was a very good salesman himself. He was very, very good. So he was able to sell this guy on coming in. But what happened? Well, what happened was they determined that the channel strategy they were going to follow wasn't the right strategy for this company. But that's not how they were going to be able to sell it. So sell the technology. So then what happened? They determined this was the wrong guy. But he had this poison pill, is what you might call it. He had the ability to say to them, no matter what happens, I own 2% of the company, because what they put in the contract was just that. It was just that simple. So now we have a problem. We have a problem because we have the wrong person in the job. He was going to, they were going to fire him because he was the wrong person. Again, he went on actually to do some very successful things. So it wasn't like he was bad, it was just the wrong position for that particular person. So we had to negotiate. Then that's when I got the call, which is, hey, we have a small problem. We put this into our contract. Now, how do we get out of it? So actually what we did with him was we figured out a way to essentially give him a certain amount of equity today, which was equal to 2%. And instead of making him pay for it, we just granted it to him, then we trued him up on his taxes, and at the end of the day, he agreed to waive that provision that would not apply in the future. So as sort of a postscript and how that plays itself out, when we sold the company, he had about 50,000 shares, and we sold it for about $6 a share. And he paid about, well, he didn't pay it, but he would have paid about the equivalent of 50 cents a share. So he made around $300,000. A 2% interest in the company at the time of sale was worth $5 million. So if we had let it in there, we would have had a problem both with every investor we brought in who would have said, well, then you drew me up in the same way, and with the fact that, we had paid this guy so much money on a sale, and he was gone before they ever really executed the strategy. So the next key negotiation that I wanted to talk about is the first important customer that you're trying to get for your business. And the reason is that, again, from the startup's perspective, there may be a lot of things that you want to get out of that customer. And it may not just be, we want to sell them the most product we can for the most amount of money. It may be that you've got a technology that you haven't completely sort of test-driven yet. So you've done it in the lab, you've talked to a lot of people about it, but you don't know what it's really going to be like when you put it into that setting that you're going to use that software in, or whatever the particular technology is. So from your standpoint, while on the one hand, it may seem like, gee, the only thing that matters is, can I get a really big sale here so that I can fund my company, or so that I have something that I can take to a financial person and say, look at what I've done, do you want to put some money in my company? The fact is that may not be the most important thing to you. What may be really important to you is, can I publicize the relationship that I have? Not like in a paper, but just a press release, or something where when other people come to me, can I tell them that I have this party as my customer? And the reason that's important is because most of their contracts will specifically prohibit you from doing that. So if you want to get it, you're going to have to actually negotiate with them as to what that would be and how I would use it. From their standpoint, just to sort of go on the other side of it, they're interested in a lot of things. One of them may be, can I get a great deal at this point in time with this early stage company? They seem to have this solution. It seems to be phenomenal. Can I get in the door with these guys? But one of the companies I represent now is in the alternative energy space, and it's a big public utility. And in every deal we do with them, a lot of times they'll make a financial investment, but they'll also have sort of a side letter. The side letter will say, these are the other things that we want, in return for making this investment. And every time we start off, they always say the same thing to me on their behalf. We don't care if we make any money on this. So don't negotiate this from the standpoint of trying to get us the best deal or whatever. Here are the 4 things we want to get out of this relationship. We want to know what's going on in this space. We want to be able to talk to these entrepreneurs. We need them as a means of staying in touch with areas in our technology or what we do that are changing very rapidly that we don't really understand. They're touching customers that we don't really touch. So it's just different because when we go into those negotiations, the assumption is always we're going to really play hardball with them because we're a big party and we can impose these different rules on them. And our party never wants to do that. But they do want to have the commercial relationship with them so that they can get access to what they're doing. Always under NDAs, it's always protected. So from the startup standpoint, it's not, they don't want to take the ideas, they don't want to do anything with the ideas. They just want to know what's going on in the space. In that area, I was also going to touch on sort of some of the things that can go wrong in these relationships. But I think I'm going to capture that a little bit further back when I look at this raising capital aspect. So as we go through sort of the life cycle of the company now, you've actually licensed the technology, you've brought on your first key hire, you've, let's say, built out a management team, you've landed a significant customer, or at least an early adopter of the technology that you can use in some way, and now you're ready to go out and raise some capital. And again, from the startup's perspective, there may be multiple things that you're interested in. And on one hand, the obvious is, well, what kind of valuation can I get on my company, and how much equity should I be selling here? And that's usually the most important factor when all is kind of said and done. But it could also be important to you to actually build a relationship with a financial investor, to get somebody in that you feel comfortable with, and that you feel can grow with your company will be able to put in the additional capital when you need them to, and so on. So while it's largely a financially driven decision about where you take the capital, I'm only suggesting that as you go through the process, there may be a trade-off that exists between a financier that you really like, that you feel maybe even knows your business, the space that you're in much better, and the party that's willing to give you more capital at potentially a higher valuation, but you just don't feel that you mesh with. From the other party's standpoint, the relationship is generally, if they're a institutional investor like a venture fund, it's less important in that regard. So they definitely want an entrepreneur that they can work with, but at the same time, they're working around financial metrics in terms of what they want to make on a given investment, how long they think it will take before they can make that return on their investment. So as you go through the negotiation, again, it's important for you as a startup to determine what is really important to me. And I can tell you that in many of these instances, if you bring on someone from the industry who has particular knowledge, who has a network that they work from, that can be extremely valuable. One of the companies we work with quite a bit, not to do an advertisement for them, but is Edison Ventures. And they're a really sophisticated investor. They'll come in, they generally won't invest unless they do like the entrepreneur and the team. But over time, they will open the company up to a whole network of other people who have industry-specific knowledge and can help the company. They have a network of, they call it their director network. And within that network, they can bring in people that can help the company at different times. And so, again, when we see them as investors on the other side, we know they're very sophisticated. They try to be very fair, I think, with the companies themselves, but of course they're financially oriented and they're all about the return on investment and so on. But there are certain ones out there that they're very, very good, and there can be a little bit of a trade-off in valuation to get certain people as investors, but it's, in most cases, it's really worth it. So I wanted to turn back to this TechRx example, the pharmacy software company, to kind of complete the circle of how things worked out for them. So they were about a $12 million company. It started the company. They had a core technology they were working from. They acquired a couple of other small companies using equity and built from about $6 million in revenues to about $12 million in revenues, but really were not making a dent in the market. They weren't really making any money, but actually nobody was making any money in that market. So the CEO, who was a very, very smart guy, went to a much bigger player in the industry. There was one fairly big player, and they were a public company, and they had a small division that did this, and they had about $35 or $40 million of sales in that division. He went to that public company and said, look, why don't you do this? Why don't you buy me out? I have a solution. I think that we can broaden the solution. We've determined we don't want to sell it this way. We think the way it should be sold is that we should try to sell into really big pharmacy chains, because today they're all doing the one-off thing too, or they have a homegrown solution which isn't actually that good. And what we'd like to do with them is offer them an industry-leading solution that would allow them to connect across their chains, consolidate all this, come up with a really new solution. And we're kind of working on that. So why don't you buy us? And we'll do that for you. And so the public company said, look, we're losing a ton of money today in this division. We really don't even want it. So, we were 12 million in revenues, they were 35 million in revenues, and they said, why don't you buy us? So then the CEO, again, a really smart guy, kind of took a step back and said, if I was a $50 million company, I'd be a giant in this industry. And everybody would listen to what I had to say. So if I started to tell them I'm working on this solution, I think I could convert them to the new thing that I'm building, right? So he went back to the public company and said, I would love to buy you. I have no money to buy. I have 12 million, I've raised probably 5 or 6 million in capital. I'm losing money like you are, but I think this is the right solution. So at the end of it, the public company sold their division to him for equity. They took his equity. So they owned about 30 or 40% of the company. And then he said, well, that doesn't really solve my problem, because to build out the rest of this, especially now that I'm running a bigger company, I need about $20 million. And they said, how about we invest the $20 million in your company? So that's what they did. They invested the $20 million. So now they owned about 40% of the company, I would say, in exchange for this. So as it turns out, one of the other things that they had was they had relationships with these big pharmacy chains, which were the same ones that exist today. It was CVS, it was Walgreens, and it was Rite Aid. Those were the big three back then, 15 years ago, same ones today. So that was the other advantage that he got out of the deal, was they had relationships with those. They were already selling into them sort of these onesie-twosie solutions, nothing that was that comprehensive. And so in the end, that's the transaction that he was able to kind of work out. And he evolved the model to basically providing that solution. He signed a big contract with CVS. And then he sold the company back to the original seller. So the company that had sold him the $35 million division bought the whole thing back for $250 million, but they did own about 50% of the company. So they paid about $125 million for the part they didn't own. And what it sort of shows you is he evolved both the strategy of the company and his negotiation strategies over time to be able to achieve a much bigger objective for the company in question. And he really was, I mean, this really was a startup company when he first bought the first part of it. It was about $2 million in sales. So he's an extremely good negotiator. Oh, I wanted to tell you one thing about it, which was when we were negotiating the sale of the big company to his company, I remember calling him and I said, you know, I feel kind of bad here, because I got to tell you, every time we go in and negotiate with them, I just feel like we're losing, right? So I was sort of, it was maybe more my personal ego than anything else, because basically they dictated almost everything in the deal. So we negotiated around the corners, I mean, the edges, but, and I just remember he told me something then, which I never forgot. And he said, you're not getting the picture here. Without that company, I'm nothing. So it doesn't matter whether we lose everything, as long as at the end of the day, I own that company and they put that money into my company. Don't worry about the details here. Just get it done. You're doing a great job. I get it. You're fighting with them. You know, you're doing the best that you can. Go in there and finish it up. Let's get this thing done. And so part of the lesson with this is, you know, so many people go into negotiations and they want to win the negotiation. But it's not really about winning the negotiation. It's about achieving the objective you have in the negotiation. So you can feel good when it's all done because maybe you beat up on the other person, and there's certain people who negotiate, that's the way they like to negotiate. But the most important thing is to know really what you want out of the negotiation at each step of your company. To try to achieve that, give yourself the buffer for what happens if that doesn't, you know, that doesn't come through, so that you can get out of a bad relationship if it doesn't work, and just continue to move the company forward. So with that, I would just take questions or comments or whatever you have. I just didn't want to endlessly go on with the war stories. So Beth, let me know if you have any questions.
I'm just curious about how they laid their objectives out on the table, because not everybody's ready to do that so easily.
What do you mean how they laid their objectives on the table?
With the story about buy us, we don't want to buy you.
Oh.
And that sounds like it, you know, could betray some internal
He
secrets.
actually told them exactly what he planned to do. And he had done virtually none of it. But he said, this is what I want to build. This is what I believe we can build. He sort of, I was in the conference room, he sort of sketched it out for them. And I said to him later on, did your engineers, anybody actually, he said, no. But we know we can do it, and they did do it, but of course when you scale a solution across, the fact it tied into mail order systems, the phone system, mail order, pharmacies and all the rest of it, it's very complex. I mean, we try to scale that to the fact that there could be 1 million transactions happening, in a day on that system. It's complex, and so they had problems as they actually went to implement it, but in the end, it did work. They did have a big, CVS. I think Walgreens built their own solution, but CVS did buy that solution. Yeah.
Do you have any stories or experience with spin-offs, and if you have any advice on spin-offs and what's the relationship and how do you, it's possibly, my startup might be a spin-off, so that's why I want
You mean a spin-off from the university or from
No,
a
from a parent company.
Okay.
Yeah, and so I've never been in one. So, I've done a startup from scratch. Not spin-off, this might be a little bit different. Just wanted to see if you have any experience or advice.
Yeah, well, we see those too, not as often as, let's say, the pure university startups. We did one that came out of CMU 3 years ago. They got a significant amount of funding. It's a slightly different negotiation because on the one hand, the company that originally had that technology in-house may overstate the value of what they believe they have versus what needs to happen next. At the same time, the company involved there was very cooperative over time, so when they spun it out, they put some more money in, they gave them office space for free. They really continued to support the company, and their primary interest was that they could use that solution as it evolved in their business. Yeah. So I think, again, the dynamics there are to try to figure out, are they willing to spin it out? So part of the reason they wanted to spin it out, the bigger company, was they didn't want to fund the whole company. They didn't want to put the whatever $10 million in that it would take to develop the rest of this. So I would say today they still own a 15-20% stake. The company's done a couple rounds of financing. The relationship with the spin-out company, with the parent, is very good. And they've always been really supportive. So I don't know, how would you describe the relationship you have with that parent?
Well, we are in the beginning stages, so we are developing the technology. They'll be more like a holding company, to put it that way. So I don't know. We haven't talked anything yet. We're just figure out the problem and the solution, and then maybe we'll figure out later.
Well, we did have an issue early because the intellectual property was owned by the parent company. There was no doubt about it that these guys sort of came in there as a work for hire, and then at a certain point, someone determined maybe we should spin this thing out because we're going to need a lot more capital. We don't want to provide it, and let's see what they can do.
Right.
So
it's a similar. I mean, in terms of like capital, we probably will have to raise from outside.
Yeah. And I don't know what percentages they started from, I don't remember, but it was much higher than what we ultimately ended up with. Yeah. And it just took some really constructive discussion, honestly constructive discussion with them, for them to understand that we're not nearly as far as you think we are.
And maybe another curious question, like in terms of timing, like what are typical, what are lengthy negotiations and what are short negotiations? I'm thinking employees probably be short, maybe sales might be short, but things like M&A or mergers and acquisitions, they seem like was it 3 months, 6 months, a year, 2 years? What's
well, that one actually, sort of to what you originally asked, that one took a while, not so much because we were constantly negotiating it. It was just, I think the parent company sort of committed and then maybe took a couple steps back from it and said, is this really what we want to do? Should we look at doing it a different way? So I said from beginning to end, was probably about 6 months, but it really wasn't 6 months of negotiation. It was
Right.
sort of, we had negotiated something, we thought we were final, then they sort of backed away from it and said, we're just not sure if this is what we want to do. And then a month or two later, they came back and said, yeah, we think this is the right thing to do. So the other ones can take a long time, in the merger and acquisition, that's about a 6-month process. It can be shorter, but from sort of first contact through end contact, it can be about 5-6 months. Yeah. All right. Okay.
Thank you.
Yeah, thank you. Thank you.